The world is now more in debt than at any point in human history. Governments, corporations, and individuals collectively owe $315 trillion. That's 3 times the entire global economy. Every year, 10% of everything the planet produces goes just to paying interest on that debt. Not paying down the principal, just interest. And here's what nobody's talking about. That debt isn't going to get repaid. It can't be repaid. The system is designed so it never gets repaid. But the interest payments keep flowing from workers to creditors, from poor countries to rich countries, from the bottom to the top forever. For decades, governments and central banks have operated on a simple principle. When the economy slows down, inject money, lower interest rates, print currency, bail out banks, do whatever it takes to prevent pain. And it worked, sort of. We avoided deep recessions. We kept asset prices high, we prevented mass unemployment, but we never did the opposite. We never took our foot off the accelerator during good times. We never let bad businesses fail. We never cleared out the deadwood. The result is $315 trillion in debt and an economy addicted to cheap money, propped up asset prices, and zombie companies that should have died years ago. Now we're facing something different, a recession that might be unavoidable. Trade wars, actual wars, interest rates that can't be cut because inflation is still elevated, and a debt pile so large that even a small economic contraction could trigger cascading defaults. Some economists are saying this is the recession we need to have, that it will clear out inefficiency and reallocate resources to productive areas. But here's the problem. This isn't a controlled burn to clear dead brush. This is a forest fire started by reckless policies with no plan to contain it. Let me show you why $315 trillion in debt means the next recession won't be a correction, it will be a catastrophe. To understand why this debt matters, you need to understand what recessions are supposed to do, because not all recessions are the same. And the one we're heading into is fundamentally different from the ones that came before. A recession, in the most basic sense, is when an economy produces less than it did previously for 2 consecutive quarters or more. GDP declines, unemployment rises, business activity slows. But why does this happen? There are 2 types of shocks that cause recessions: supply shocks and demand shocks. Supply shocks are easy to understand. Something physically prevents production. A pandemic shuts down factories, a war disrupts shipping, a natural disaster destroys infrastructure. These make intuitive sense. We have less stuff because something stopped us from making stuff. Demand shocks are weirder. Nothing physically prevents production. Factories are operational. Workers are available. Supply chains function, but people stop buying. Businesses stop investing. Everyone holds on to money because they're scared. And because businesses can't sell what they make, they stop making things. They lay off workers. Those workers have less money to spend, so other businesses see their sales decline. More layoffs. The cycle feeds itself. This is what happened in 2008. Nothing physically broke, but confidence collapsed. Credit markets froze, and the economy contracted even though we had the capacity to produce more. Here's the thing about demand-driven recessions. They serve a purpose, a brutal, painful purpose, but a purpose nonetheless. They clear out businesses that shouldn't exist, companies that are inefficient, over-leveraged, or producing things nobody actually wants. When times are good and money is cheap, these businesses survive. They borrow to cover losses. They raise money from investors, chasing returns. They look successful on paper, but they're not adding real value to the economy. They're zombie companies, and recessions kill zombies. The dot-com crash in 2001 is a perfect example. In the late 1990s, any company with a website could raise millions. Pets.com, for example. Dozens of businesses with no revenue, no profits, and no realistic path to either. Just hype and investor money. When the bubble burst, these companies died quickly, and that was painful. People lost jobs, investors lost billions. But the resources those companies were consuming, the capital, the talent, the attention, got reallocated to Google, to Amazon, to companies that actually built sustainable businesses. The crash cleared the deadwood, and the economy grew back stronger. The 2008 financial crisis was similar. The recession was triggered by a housing bubble and derivatives that amplified the damage. But underneath that was a more fundamental problem. The economy was overinvested in real estate and financial engineering. Too much capital flowing into flipping houses and creating complex securities, not enough into productive businesses.
The crash forced a reallocation.
Resources shifted away from mortgages and toward other investments, at least in theory. In practice, governments and central banks intervened so aggressively that many of the zombie companies survived, and that's where the problem started. Governments borrow to fund stimulus. Corporations borrow because rates are low. Individuals borrow because asset prices keep rising and they need to keep up. The debt allows everyone to delay consequences, to avoid the pain of restructuring, to keep zombie companies alive, and to keep asset prices inflated. But debt has to be serviced. Interest has to be paid. And when 10% of global output goes just to interest payments, there's less left for everything else: investment, consumption, growth. The debt is a weight dragging down the economy, and it's getting heavier. Now, let's talk about what's happening right now, because we're likely already in a recession or about to be. The data is messy. It takes months to collect and verify, but all the signs are there. Trade wars have created uncertainty. Businesses are delaying investments. Layoffs are increasing. Consumer confidence is falling. And here's the critical detail. This recession isn't being caused by overinvestment in a specific sector that needs correction. It's being caused by policy chaos. Tariffs announced and then walked back. Threats of trade wars that may or may not happen, geopolitical tensions escalating. This isn't clearing deadwood. This is setting the entire forest on fire and hoping something useful grows back. Some people are arguing this is actually good, that we need a recession to rebalance the economy, that globalization went too far, that manufacturing jobs were outsourced and communities were destroyed, and that a recession will force companies to bring production back. There's a version of this argument that's coherent. If you genuinely believe the economy is overinvested in global supply chains that are brittle and vulnerable, then yes, a shock that forces diversification could be beneficial long term. But here's the problem. That's not what's happening.
What's happening is chaos without a plan. Tariffs that hurt both exporters and importers. Uncertainty that prevents any business from making long-term decisions.
And a debt pile that makes the entire system fragile. Let's talk about that debt pile, because 315 trillion is an abstraction. Let me make it concrete. Governments owe approximately 100 trillion. Corporations owe another 100 trillion. Households owe roughly 115 trillion. All of this debt was accumulated during a period of low interest rates. From 2008 to 2021, rates were near zero. Governments borrowed cheaply. Corporations issued bonds at 3 or 4%. Consumers took mortgages at historically low rates. This was sustainable as long as rates stayed low and economies kept growing. But rates aren't low anymore, and growth is slowing. When debt was issued at 3% and now has to be refinanced at 7 or 8%, the math breaks. A company that could service debt at 3% goes bankrupt at 8%. A government that could pay interest at low rates faces a fiscal crisis at high rates. A household that could afford mortgage payments at 3% defaults at 7%. This is the refinancing wall, and it's hitting now. Over the next 2 years, trillions in corporate and government debt need to be refinanced, much of it at rates that are double or triple the original terms. Some borrowers will manage, but many won't. And when defaults begin, they cascade. Here's how the cascade works. A company defaults on its bonds. Investors who hold those bonds take losses. Those investors might be pension funds or insurance companies that have liabilities of their own. If their losses are large enough, they can't meet their own obligations, so they default or they're bailed out. Either way, the losses spread. This is what happened in 2008. Lehman Brothers defaulted. Every institution that had lent to Lehman or bought securities from Lehman suddenly faced losses. Some failed, others needed bailouts. The contagion spread globally within days, and that was with 60 trillion in derivatives. Now we have 600 trillion in derivatives and 315 trillion in debt. The interconnections are far more complex. The potential for cascade is far greater. Now let's talk about who gets hurt in a recession, because it's not evenly distributed. Recessions are brutal for ordinary people. Workers lose jobs. Small businesses close. Families lose homes. But for people with significant wealth, recessions are often opportunities. Asset prices fall. The wealthy buy stocks, real estate, and businesses at discounts. When the economy recovers, they're richer than before. This happened in 2008. Millions of families lost their homes to foreclosure. Private equity firms and investors bought those homes at auction for 50 cents on the dollar. Now they rent them back to the same families who lost them. In 2020, when COVID hit, rates were already low, but the Fed could still act. They printed 4 trillion and bought bonds. It worked. The economy recovered, but now rates are around 5%. If they cut to zero again, they risk reigniting inflation that just required painful rate hikes to control. If they don't cut, the economy crashes harder. There's no good option. Government borrowing is similarly constrained. In 2008, U.S. federal debt was about 67% of GDP. The government could borrow to fund stimulus and bailouts. In 2020, debt was higher, but still manageable. Now, debt is 125% of GDP, and deficits are $1 trillion per year, even without a recession. If the government tries to borrow another 2 or 3 trillion for stimulus, bond markets will panic. Interest rates will spike. The debt service costs will explode. The government is trapped. They can't borrow enough to prevent a deep recession without triggering a debt crisis. So the tools that worked in 2008 and 2020 don't work anymore. Let me show you what happens when a highly indebted economy goes into recession. It's not a normal recession, it's a debt deflation spiral. Businesses and households that are over-leveraged start defaulting. Banks that lend to them take losses. Banks reduce lending because they're trying to preserve capital. Reduced lending means businesses can't invest and consumers can't spend. Economic activity slows further. More defaults, more bank losses. The cycle feeds itself. And because everyone is in debt, there's no cushion, no savings to fall back on, no ability to wait out the downturn. This is what happened in Japan in the 1990s. Their debt bubble popped, and they spent 30 years in stagnation, near zero growth, deflation, lost decades. The same could happen globally now. But here's the most insidious part. Even if governments and central banks find a way to prevent the worst outcomes, the cost will be enormous. Preventing recession requires printing money. Printing money causes inflation. We just experienced this. From 2020 to 2023, governments printed trillions. Inflation hit 9% in the US, a 40-year high. Wages didn't keep up. Real purchasing power declined. If central banks print another 5 or 10 trillion to prevent recession, inflation will return, possibly worse. The choice becomes depression or currency devaluation. Either way, ordinary people lose. Now let's talk about trade wars specifically because that's the immediate trigger for the current economic slowdown. Now let's tie this back to the debt. 315 trillion in global debt was manageable as long as growth continued and interest rates stayed low. But both of those conditions are gone. Growth is slowing, rates are higher, and the debt service is consuming more of the economy every year. This means less money available for investment in productive capacity, less money for research and development, and less money for infrastructure. The debt is literally starving the economy of the resources it needs to grow. And a recession makes this worse because when the economy contracts, tax revenues fall. Governments collect less money, but their debt service costs don't fall. In fact, if they borrow more to fund stimulus, debt service increases. So governments are forced to cut spending or raise taxes, both of which slow the economy further. The same is true for corporations. When revenue falls, profits disappear, but debt service is fixed. Companies have to make interest payments even if they're losing money. This means cutting costs, layoffs, reduced investment, selling assets, all of which weakens the company and the broader economy. The debt doesn't just make recessions more likely, it makes them deeper and longer. Here's the final piece. The political will to allow a deep recession doesn't exist. In 2008, governments and central banks acted aggressively because there was broad consensus that preventing financial collapse was worth the cost. That consensus is gone. Trust in institutions has collapsed. Political polarization is extreme. And populist movements on both the left and right are demanding that elites pay for their own failures. If governments try to bail out banks or corporations again, they'll face massive public resistance, protests, political instability, maybe worse. So the question becomes whether governments will have the ability to act even if they want to. And here's the darkest possibility. What if they don't act? What if the recession is allowed to run its course? Unemployment spikes to 15 or 20%. Millions of foreclosures, mass business failures, a decade of stagnation. Would that clear out the zombies and rebuild a stronger economy? Maybe, but the human cost would be catastrophic.